any
Sorry, you just cut out there, Morgan.
no worries. Any need to rearrange the agenda?
Oh, no.
Okay. And any announcements from staff there or from other board members?
None from staff.
Okay.
Nope.
I will go ahead and entertain a motion to approve the agenda then. And Bill, I'm going to rely on you to record the movers and the seconds.
Absolutely, Mr. Chair. I have a motion from Mr. Potter.
John and Dave. All right, all those in favor of approving the agenda, please say aye.
Aye.
Nice.
Just to confirm, who was the second?
Aye.
Thank you.
I think I hear Kim now.
Yeah,
Yes.
hi.
Great. And you can put me down as a second for that if you need to.
That's okay. I have Ms. Gleason.
Okay.
Thank you.
And so we have approved the agenda. The next item is approval of the minutes for the January 20th, 2026 meeting. Would someone like to make that motion?
Yep.
And a second?
We have a second from Ms. Gleason.
And all those in favor of, well, is there any discussion on the January 2026 meeting minutes? Hearing none. All those in favor of approving the minutes, please say aye.
Aye.
Aye. Any opposed? Okay, minutes are approved. Is there anyone there for public comment in the room or on Zoom Teams? Sorry.
No one present in either that is outside of the, third parties that we have normally invited.
Perfect. Then we will move right ahead to the DC Plan biannual review. And Tim, I'll let you tee it up.
Thank you, Mr. Chair. So today we're going to be going through the VMERS DC plan. We have Gabe from Empower, who's going to go through some plan performance highlights. And then we have Sarah and Ramneek from RBK, who will go through the investment review for the plan generally. We're going to do a brief investment policy statement review. The purpose there is to get in the habit of an annual review of that statement. I know we just adopted, so this year it's not going to be very much in depth. We've just gone through it, but we wanted to get it on the calendar so that we have that kind of calendared muscle memory to do it every year. And then we do have one item on the watch list that we're going to bring to your attention that we'd like to, that we have a suggestion for action on. So that will be the structure of the review. And with that, I'll hand it over to Gabe to walk through some highlights on the plan performance.
Thank you, Tim. Good morning, everyone. Happy New Year to some of you who I have not had the chance to meet yet this year. And to those of you that I have, welcome back. Good to be with all of you. With respect to the plan summary, before I share the plan summary, I'm just going to provide just some high-level overviews, if you will, year over year from 24 to 25. Again, just a couple of points. You don't have to write this down. I'll eventually send out an email to Bill about this,
Hey,
and then
Gabe,
I'll share some.
Gabe,
Yeah.
Can I jump in and make a suggestion? You're
Of
a little
course.
choppy. You're a little choppy. I wonder if going off video might be helpful because it's sounding a little hard to hear.
Okay, how's that? Still
I think
chop?
it's a little.
Can you guys
I
hear
think
me?
it's a little. Yeah, I can hear you.
Okay. If
You're kind of
anybody
frozen
else,
on video.
well, I just closed my I shut off my camera.
Okay.
So if I still come across choppy, just wave or something. I'll try switching headsets and things. Okay, guys?
Okay, it sounds better. Thanks.
Okay, very good. Before I share my presentation, I just wanted to just give a couple of high level year over year, just from 24, full year 24 to full year 25. So asset growth and participant base, you don't have to write this stuff down. I'll send an email to Bill, but generally speaking, assets have increased 31.5 million in 24 to $34 million in 25. It represents about a $2.5 million increase, so approximately 8% year over year. participants remain stable at about 421 participant accounts. In terms of the average account balance per participant, the average account balance increased from 74,700 to 80,100, an increase of about 8% with that. And again, account growth, if you will, outpaced kind of participant growth, which was flat, as I indicated. And a lot of it is because of it, the positive investment returns and some improved savings activity that participants have done. For example, the retirement readiness metrics, the lifetime income score, the average score. This is kind of the replacement ratio for those of you that go online and play around with that account. The replacement ratio score improved from 75% to 90%. And the median score increased from 62 to 68%, again, due to the valuation and appreciation, which Sarah is going to get into the investments and talk about the results there. Contributions and cash flow, I'll get into it. $7,000 and 20 contributions.
Hey,
$1
Gabe.
million. Yeah.
Sorry, we're struggling a little bit.
You're still choppy? Okay.
A little choppy.
Is that any better?
I think so.
Okay. If not, I'm going to try one more headset. If I can go grab that real quickly.
This is sounding okay right now. Yeah.
It is? Okay. I apologize, ladies and gentlemen. So I would say contributions in for $900, just shy of for 25, $1.1 million, representing about a 17, almost 18% year-over-year increase. Net activity of about a negative $900,000 in cash flow, and we're going to get into that a little bit. Contributions improved, but distributions increased at a faster pace in 25 due to large net negative cash flow. So I'm going to just pull up my report right now. But basically, overall assessment is as follows. We had about an 8% asset growth, an 8% increase in participant balances, strong improvement in lifetime income replacement ratio, and an 18% increase in contributions. So I'm going to share my presentation, hopefully, and just touch on a couple of pages. Can you all see this?
Yes.
Excellent. Thank you. Just going to go to full screen here real quickly. Okay. As I said, 34 million at the end of December, representing 421 participants, average account balance of almost $81,000. We're going to just briefly touch on the investment utilization and, of course, the allocations by asset class. In terms of cash flow, so for the year, again, 1.1 million for 25, 3.8 million in disbursements, representing of almost $2.8 million in net negative cash flow. And we get a quarter-over-quarter breakdown here, folks, in terms of the activities for the quarter. But the line I'll point to the change in which was the market valuation on a quarterly basis. First quarter was down 500,000, and 3 million positive, 2 million positive, and almost $900,000 positive in terms of market increase valuation. The contributions, the 1.1 is made up of 567,000 in employee before tax contributions, and another 560,000 for those that receive an employer right there in terms of contribution and contributions. We look at the $4 million in distributions for the year. 3.5 of the 3.9 were two types of distributions. One of them being a separation from service, as well as people that are taking installment payments. Is there a question there? That I have a question raised? Was that Sarah?
Hi, Gabe.
Sorry to interrupt you.
Gabe, oh, sorry. No, I was saying, would be helpful if I share materials. I think that might help with your audio.
I'm sorry.
Let me know. Would you like me to share the book? I think it might help the audio.
Well, I just got a couple of pages if it's okay with everyone, but thank you for the offer. Everyone can see this, correct?
Yes.
Yes. Yes.
Very good. Okay. Thank you, Sarah. So in terms of that distribution, there were some required minimum distributions and sadly some death distributions, but the majority of distributions were from separation from service and from regular individuals that have separated or retired and have taken installments. We did have a large distribution in November. I think it was one participant that withdrew quite a bit of money, because you could see the run rate here with respect to distributions out of the plan. Those were for those death distributions and things of that nature. But as you can see here, the majority of distributions generally run around $1 million, a couple $100,000, excuse me, I should say. But we did some large distributions towards the end of the year that were attributed to retirement, separation from service, and rollovers out of the plan. In terms of investment strategy utilization, and we'll just put some numbers next to that. As you all know, there's really 4 ways that participants can invest when they join this program. 26 participants represent 1,000 or 1% of the assets represents what's called managed accounts or advice, My Total Retirement. This is a paid for service that participants pay to have their accounts professionally managed. There's one person utilized the free online advice. The target date strategy is almost 40% or just under $15 million. The asset allocation, which is the goal maker asset allocation tool. And of course, the individuals, a good bulk of the individuals representing 16 million in assets or 48% of the assets, almost half, are the do-it-yourself strategy. So you got, again, 4 different ways to do that in terms of how participants want to invest their money. And then we can break down the individuals by statistics, whether they're active or separated here. The interesting thing that I'll share that we see at Empower and across many of the plans is that participants, once they do separate from service, they're no actively employed, that they do stay engaged and they do stay in the plan and continue to utilize the tools. It's very important. Participants know that one of the benefits is for them to stay in plan, and maybe more participants are doing that at higher percentages and rates year. They still have about $3 million invested in their target date strategy, for example, and you can see the differences there. And then we break down those pieces, for example, over the course of the year. The advisory services, which was part of the new contract, it started with about 19 individuals at the beginning of the year. Now there's about 26 individuals. At some point, a lot of these will level off, these services. So advisory services, we've got 26 participants today. And then again, more detailed background for you based on age group and demographic data. And then GoalMaker, which is the asset allocation tool, pretty much hovered around the 43% participants that have been in that plan since inception. Again, representing about at the 10% participation, 5% of the assets, and $1.7 million. And then again, more demographics behind each of the various components based on investment strategy, conservative, moderate, aggressive, and of course the demographics and age group and balances. And then we kind of roll up, if we will, in a second here, all of the programs based on all of the investments currently in your plan today. So on page 22 and 23, these are all of your funds, from your Fidelity Advisor life cycle funds to all of the other individual strategies, and then account balances in those relative strategies. And those that do it themselves. So you can have an idea of how the funds in the plan are being allocated depending on the investment strategy that participants utilize there. I know I'm going really quick through here. And just a snapshot from 24 to 25, as I said, the assets of 24 versus 25 and the number of participants, et cetera, so forth. That transfers, then insights, again, more data, average account balances, and then are the Empower communication engines, which kind of calls out and shows the different methodologies which we reach out to your participants, engage with your, and then some of the results of those campaigns and things that participants do and how they're managing their account. And then we compare your plan to peers and the top peers. So for example, just, with a beneficiary on file, you have 51% of your participants have a beneficiary on file. Top peers at 89, most peers at 65. That's something we may need to target. And I'm sure, when participants do call, we do see whether or not participants have a beneficiary and make sure that they have the ability to make sure that they do name a beneficiary, because it's very, very, very important to do that. How many people are enrolled in managed accounts? 6% your plan, 9% period. And then what they do and the activities they take with respect to their planning and optimizing some of the tools in the plan, and then some numbers attributed to the plan. For example, planning and optimizing year to date, we had 3 people, 11 set up, 6 year to date in my retirement. Again, 41 people year to date registered, and the importance of registering. So we just kind of show different metrics based on how participants are using the plan, what they do, and how they do it. I put a lot of data out there for you, but again, as I said, summary, with the exception of some high rollovers earlier on, at the end of one individual, the plan is growth primarily due to primarily due to appreciation, but activities and participation is relatively flat. I'm happy to answer questions that anyone may have. I go back to some of the statistics here for you.
Tim, do you want to do questions now, or do you want to switch to Sarah and hold them at the end? What's your pleasure?
Either way, I'll defer. Happy to go. If board has questions now for Gabe, we can go, but Sarah will cover some of this and get into more in depth on the investments, so we can just move forward with that as well.
Okay. Let's do that, and maybe Gabe's connection will get better over the next few minutes, and we'll turn it over to Sarah.
Thank you, and my apologies for that. I'm going to go swap the headset, but thank you. I appreciate your time.
All right. Thank you, Gabe. Good morning, everyone. So today I'll start with a quick investment review with you all, and then we have on the agenda, as Tim mentioned, the IPS policy review, and then the watch list policy update, which will be a quarterly deliverable. Just a chance for us all to spend some time talking about managers maybe on watch at the time, and taking a bit of time just to go a bit more in depth on those managers and share our thoughts. So with that, just a couple of minutes on the market itself. Definitely 2025 has been an eventful year overall. There has been a lot of volatility in markets. A lot of folks were calling for a potential recession. But if you look at the market performance on the lower left-hand side, you'll see nearly all markets over the year-to-date and the quarter-to-date have been positive. The S&P 500's performance was double-digit, and so were other developed markets, and bond markets also did really well. Looking at the economy overall, inflation continues to drift lower. The labor market has softened a bit over the last few quarters, but it remains very healthy. In terms of GDP growth and the growth of the economy, full year 2025, we now expect real GDP growth to come in at around 3%, which is slightly even higher than the long-term average. So that's pretty great. If we want to maybe look more closely at markets, within equities, you remember that there was some drama maybe in Q1 and Q2. But like I said, equity markets deliver strong full-year returns driven by, within the US, mega cap technology names. But international markets also did really well. And 25 was a year where diversification really mattered and had an impact on performance. In 2026, we're seeing a bit of a different story unravel this year. We're seeing some rotation from growth and technology and large cap towards small cap and value. And we're seeing continued outperformance from emerging markets and non-US equities in general. Looking at bond markets, after a couple of challenging years, 2025 was also broadly positive for bonds due to falling inflation, falling policy rates. And earlier this year, after 3 rate cuts in last year, the Fed confirmed that they are staying put and they are going to be data-driven. Markets does expect a couple of 2 to 3 rate cuts this year. So overall, really positive story. 2026 seems to be a year of normalization. markets are broadening beyond the handful of mega cap names, which is good for diversification. And folks in your plan who are invested in asset allocation funds and asset allocation services and are currently diversified across asset classes. So they are really poised to do well in the year to come, and potentially obviously long term as well. Active managers are expected to really shine in a year like this, where we're seeing more divergence in performance. So that's really all I wanted to mention on capital markets. But please stop me or let me know if you have any questions on that. If not, maybe we can jump to page 16 and do just a quick plan update. So overall, like Gabe mentioned, assets are at about 34 million, down slightly from the third quarter. Markets performance has been positive across your funds, but outflows in the fourth quarter slightly surpassed inflows, which you can see at the bottom left-hand side. Where there are more distributions in Q4. That's something we see actually across plans, where Q4 is where we typically see majority of the outflows, but throughout over the year, there's been slightly more outflows than inflows. If you look at average balances on the top right-hand side, after 3 consecutive quarters of increasing average balances, we saw a bit of a reversal there, at least on the average balance front. Median balances are actually slightly higher compared to the third quarter. The next page looks at how folks are using the menu. Gabe touched on that. Also, overall, we like to look at the do-it-for-me category. You offer participants multiple ways to invest. You offer 3 different ways they can delegate the asset allocation decision. You offer them target date funds, but you also offer them managed accounts and goal maker. And across the 3, we see 77% of participants have opted either for the target date funds, managed accounts, or goal maker. And then the rest of the participant base are really invested in the core menu on their own. Some of them are invested in both the core menu and the target date funds, something we see across plans. If we turn to page 20, and page 20 and 21 are really offer a high-level overview of key metrics and indicators that we think are helpful to review every quarter. And overall, you offer participants 18 different options. Majority of participants are in the active options, majority of assets, 58%, and then 10% of assets are in the passive options. The most popular option, if we turn to the next page, most popular option here is the Fidelity Blue Chip Growth Fund. It has 16% of assets, and then maybe a far second are the S&P Index option and the Stable Value Fund option. Both are typically options that we find to be very popular in DC plans. Now, this dashboard and the page, can we go to page 21, Remy? Now, this page, thank you. This page looks at some key qualitative and quantitative indicators that we think are important to review. And we will be flagging any changes that we think are potentially adverse or may have an impact on long-term outcomes. But we won't flag anything that we think is just a part of the normal course of managing a fund. And there are usually changes, there's usually turnover. So we won't be flagging anything except what we think are maybe worth taking a closer look at. So we have one update to flag for you all today with the State of Vermont Stable Value Fund. There has been some organizational changes there within the fund. Their CIO has recently departed and has been replaced by the head of investment strategies. They also hired a new head of fixed income. We'll talk more about that during our watch policy review. So more on that later. But beyond that, there has been no new changes across strategies, except that We flag Columbia, Acorn International as well here, given that we are still continuing to see some changes in their organization and strategy that we think are worth spending more time on, and we'll talk more about that later as well. If all your other strategies continue to maintain the same ratings as last quarter, there has been no manager rating changes, and many of them have a positive rating. As you can see, fees are generally in line with peers, with the exception of the State of Vermont Stable Value Fund, where fees are a bit higher than what we would expect for assets in the fund. And like I said, we have currently 4 managers on watch. Within active U.S. equity, we have the Domini Impact Equity Institutional Fund. We also have another sustainable strategy, the Impacts Global Fund on watch, the Columbia Acorn, as I mentioned, and then State of Vermont Stable Value Fund as well. More of those later, but when it comes to performance overall within your funds, if you look at the prior page 20, the Fidelity Target Date Fund continues to rank well relative to peers over the long term. Overall, this is a strategy that is a bit more conservative than some of its peers in its equity allocation, but despite that, it has performed well due to just good manager selection and the ability to outperform its benchmark, giving strong manager security and tactical allocation decisions. On the next page, when it comes to your passive managers, all of them continue to track their benchmarks with a reasonable tracking error. Within active managers, with the exception of the managers we have on watch, and all managers really have performed in line with expectations. One manager in particular, Janice Henderson, has underperformed over the last 3 years. The performance has been challenging, but this is not something that really is specific to this fund. Small cap growth strategies in general have had a hard time outperforming the benchmark over the last few years. It's we've talked about this before, but performance has been more concentrated in a handful of names, which made it hard for active managers to do well. And a lot of clients are considering being fully passive in that space. But beyond this one, we'll keep watching it. But like I said, relative to peers, as you can see over the 5-year and longer term, it has performed in line with peers. So no immediate concerns, but we will monitor it and let you know if we have any concerns in the future. Beyond that, we think all your active managers have performed in line with their mandate and expectations. So that really concludes my remarks on all managers that are not on watch. And just to keep the meeting flowing, unless there are any questions, we can turn to our next agenda item, which is the IPS policy review. So I'll pause for a minute to see if there are any comments or questions there.
Okay. And Tim, I'll let you kind of direct the stack for questions if there are any.
Not seeing any right now.
Okay.
All right. So as Tim mentioned, the IPS review is something that we think is as a best practice. It's important to do that every year. We don't have an agenda item for it today because staff on our VK have reviewed the policy, and at this point, we don't have any recommended changes. Like Tim said, this is something that we've just adopted a few months ago, so no surprise that we don't have any current changes to recommend, but this is something that we will do every year, and we're just building that muscle memory now, and we maybe think this is just a good opportunity to encourage you all to also do the same, take a look at the policies, and let us know if you have any thoughts or feedback on that. These are our handbook for the plan oversight process, if you will, and we use it as guidance, and we refer to the policy and throughout the quarter as part of our oversight of the plan. So no recommendations on this item. Our next agenda item is the watch list policy review. Now, this is our first watch list update. At the November meeting, we came to you all with a recommendation to place a number of managers on watch. This was a result of the investment policy and watch list policy that you all adopted back in October. And as the policy stipulates, any managers where we think there are areas that warrant further review or taking a closer look, those managers would be placed on watch, and staff in RBK will do an additional level of due diligence, and we'll come back to you all at every quarter with updates. And within a 90-day period, RVK and staff may come back to you with a recommendation either to extend the watch list review period or to potentially make a change to the managers. You all have 4 managers on watch today. We are not recommending any changes for 3 of them, but as Tim reviewed with you all, for one of the managers, we are actually recommending initiating a search process, and I'll talk a bit more about that shortly. But just as a reminder, for the 3 other managers on watch, and just more generally speaking, having a manager on watch doesn't mean that we are going to come back to you all with a recommendation at a future meeting to replace them. More likely than not, we see that managers just come off watch with no recommendations. What all it does for us is make sure that we're doing enough oversight on the managers, and we're watching for any signs of deterioration in metrics, and having a structured monitoring process that will make sure that whenever there are signs of deterioration that warrant further escalation, we are acting in advance and we're not making any knee-jerk changes. And that applies to the managers we have today. So we don't make those termination recommendations very often, because in most cases, in your plans, managers are really, like I said, high quality institutional funds that we like. And Columbia Econ is really the exception here. And I'll talk more about that later. But maybe let's start with the first one you have here, which is the large cap equity options, the Domini Impact Fund. We talked about this last time, as you may remember. This is a concentrated U.S. cap equity fund that integrates ESG criteria in its process. It's benchmarked to the S&P 500. It's very hard to beat over the last few years. They have significant assets, more than $1 billion in assets, and the funds is on watch due to the underperformance that we've seen with the funds over trailing time periods. Over the 2024 and 2025, they have underperformed the benchmark. And like I said before, it has been challenging overall for managers. And this fund in particular was really structurally underweight to mega cap growth stocks like the Max 7. I'm sure you heard about that, which hurt their performance. Our recommendation is to keep them on watch while monitoring whether they will do better in the future. They have their investment approach remains unchanged. They continue to prioritize ESG, but we do expect them to do better as market performance, as I mentioned earlier, starts to broaden and we see other sectors of the market do well. So we think this will help their long-term results. And we think monitoring them makes sense at this point. Similar story with the next fund, the Impacts Global Environmental Fund. This is different strategies mandate. This is a global strategy, so it invests within the U.S. and outside the U.S. as well, both developed and emerging markets. It's on watch for similar reasons. Performance has been challenged. Similar story here. They have really not invested in those type of in those handful of names that really had the majority of performance over the last few years. We continue to recommend keeping them on watch. They have actually made some portfolio adjustments in their positioning, mostly to stay more defensive, really invest more and add more to names that they think are valuable, that really have been out of favor in the current market. We do expect them to potentially do better in the long term, especially if we see that market broadening. So our recommendation is to keep them on watch and monitor whether those portfolio adjustments will help their long-term results. The next strategy we have on watch is the State of Vermont Stable Value Fund. Now, unlike the last two names, this one is on watch for qualitative reasons and not for performance. This is it's a collective or commingled stable value option, and it invests in multiple managers within the fund. The concern that led to its placement on watch was ongoing senior level leadership turnover over the last 2 years. And more recently, Mission Square, just a few weeks ago, announced a new CIO, like I said, and a new head of fixed income, continuing this pattern of departure that we've seen across those senior investment and operational roles, which creates some questions around the stability of its leadership and continuity of the process. So while we are recommending to keep them on watch, we will have more conversations with the manager. We already had a meeting with them. Once that was announced, manager researchers will meet with them again, and we want to digest this information before we make any recommendations. But it's not something we're happy to see when we have that level of turnover. The good news here is that performance, as you can see on the page, has been really in line with the benchmark and peers. Its cash flows have also been in line with the industry as well. And another redeeming factor here is that Oliver Mang, who has been the co-lead of the strategy for years, continues to lead the strategy. So we don't think there is a reason to make any quick changes, but we think that additional organizational turnover is worth monitoring more closely, and we will report to you all with updates at the next meeting. Finally, Columbia Acorn on the next page. This is an international SMID cap, so they invest in small cap and mid cap equities with a growth bias. So it's a very specialized strategy. It actually, when you invested in this strategy initially, it was a broad international equity strategy. But the original investment team of the strategy has been terminated and has been then replaced with another team within Columbia Acorn that's now managing it. So they now have Columbia Threadneedle's global equities team in London is now managing the strategy. With that shift, they have shifted the mandate to a small mid-cap growth mandate. So that's definitely a change from its original goal and mandate that you've all added it for. Performance, as you can see on the page, has also been weak relative to its new benchmark. And as of end of year, it has underperformed across most trailing periods, including the 1, 3, 5, and 10-year periods. And we don't have confidence in the strategy going forward to be managing to that mandate. the team that is managing it now don't have a lot of experience managing to a small mid-cap growth. They have some experience, but it's not something they have done before. So a mix of significant turnover, changes to the strategy mandate itself, and underperformance have led staff and RPK to believe that this is a name that we don't really see a lot of room for them to do well or to rebound in the future. And we are currently recommending that the board approves a formal search process. And what we think would make sense here is, since this was originally a broad international equity strategy, we think replacing it with an international equity, a general international equity strategy makes sense, as opposed to having another small cap growth strategy on the menu. We actually don't see a lot of clients offering small cap growth strategy options on their menu. So our recommendation is to replace it with a name that really is consistent with the original mandate here of broad international equity. So I'll pause to see if there are any initial reactions or feedback from the board on that recommendation.
I think one thing that I'll just point out first, I really appreciate Sarah's work on this. Kind of helped me understand sort of why this fund was in a little bit of different position than the others on the watch list and merited action. And we had a long conversation about whether or not it's a pull off the fund simply versus replace it with a new one. And I like the reasons for replacing it with a new one. And that also helps us map to any of the existing funds to a new fund that's consistent with the original mandate. One thing that I just think is important for context is that this is not a fund that we have a lot of exposure to. We have about $30,000 and four participants in this fund. So it's not one that is like our blue chip fund that's, taking up a substantial portion of the portfolio. It is relatively modest. So from an impact perspective, it's not overly significant. So I think it's a good move to, identify this and move quickly on it. And that's what we've done and wanted to bring it to you for consideration.
Great, Thomas. Thank you, Tim.
Oh, go ahead.
Yeah.
I saw John had a question. Yeah.
Yeah, no, not a question. It just seems to make sense to me as well. I appreciate knowing that it's not a big part of that portfolio, Tim. But yeah, I mean, let's get our process down here and do this.
Yeah, if I'm reading page 19 right, it's the smallest plan both in assets and participants. And I had a little trouble today with the phone connection. It sounds like you're not looking a motion for the stay the course on the first three funds. You're just looking for something for this last one.
Yeah, that's right. Because the others are sort of watch and wait, whereas this is take a new step and initiate the formal search process to find a replacement manager.
Any other questions or comments from board members?
I guess I support the move to seek another provider. And is the process in sort of mapping it over to a new fund if we find a fund of the similar profile? Is that burdensome for the participants? How does that happen, or is it? I apologize also if I missed that.
No, happy to cover that. So it's a standard process that record keepers do all the time, and we've actually had have moved some funds to different share classes, and it was an exactly similar process where participants would be notified 30 to 90 days in advance. Typically, it's 45 days or so in advance. Participants would receive an email communication describing the change and where their assets would be automatically mapped. And participants would have time in advance if they want to move their assets to a different fund on the menu. They are able to do that ahead of time. Otherwise, their assets would be just mapped automatically into the new fund. And if there are any questions, of course, they are also encouraged to reach out to Empower or Vermont with any clarifications. But as Tim mentioned, given just there are a handful of participants in the fund, we don't expect this to be very disruptive.
Thank you.
Any other questions or comments?
I'd be happy to make a motion if you want.
Sounds good. Tim, do you have that motion teed up, the wording you want?
Sure. Yeah, it's generally on the that watch list page. So it would be a motion to approve the initiation of a formal search process to identify potential replacement managers that offer broader international equity exposure consistent with the original mandate.
So moved.
And I heard John make that. Is there a second?
Yes, Kim.
Moved and seconded. The motion is to approve the initiation of a formal search process to identify potential replacement managers that offer broader international equity exposure consistent with the original mandate. And this is in relationship to the Columbia Acorn International Fund. All those in favor, please say aye.
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 Any opposed? And that motion passes. Tim, anything else you want to cover under the DC plan?
No, thank you.
All right. Thank you, Gabe, and thank you, Sarah, for all your work on that.
Yeah, thank you all. Great seeing you all.
Thank you. Thank you all very much. Thank you.
Okay. And Tim, I think we're on to you and the VMERS budget.
Yes, so I'm just going to briefly share my screen. Folks seeing it?
Tim, is it okay if it's okay for me to bow out at this point, Tim?
Yeah, sure. Thanks, Gabe. Appreciate it.
Very good. Thank you all. Be well and happy spring. Here we go. Bye.
As well.
Ready on the spring. Okay, you see the screen there? What we wanted to do today is present the budget to you. And so we have a little bit of a different format this year. So what I wanted to do is walk you from the old to the new, explain why we're doing it and what a process going forward is going to look like. So it's a little hard to see, but not overly important. What I wanted to provide was the old budget that we used to provide you, the old format. This is a format that's kind of near and dear to all state budget writers' hearts that is, in my view, not very effective to, not very helpful to folks that don't live in this space. What this budget format does is it kind of makes some arbitrary distinctions about where different, for example, vendor costs exist that aren't necessarily intuitive. It kind of puts items that are, $1 million and $1,000 on the same level, and it's how the budget has to be presented for state budgeting format, but it, in my view, it wasn't overly helpful. It wasn't helpful to me, and so I was assuming not overly helpful to board members that aren't in the weeds on this. So what we would typically do is present this version to the boards in December, January time period. At the same time, we were sending it over to the legislature, and they were considering it in their budget process. And then our boards would take a vote on it, but sometimes it would change a little bit during the budget process, and we would never come back to it. So what we wanted to do this year was to present it in a bit more of a user-friendly format, kind of trying to provide that executive level overview into our operations. And at the same time, do this as a heads up presentation with the understanding that we would come back as the legislative session is ending, and we can see if the legislature looked at the budget and made any changes. Ultimately, we'd like what the legislature and the boards are approving to match up, and make sure that everyone's on the same page with the amount that we're spending for administrative expense. And so that's, and at the same time, have an opportunity for understanding and questioning. So, going forward, we might do this, might present this a little earlier in the process too. But I wanted to get this in front of you guys and see if this format works and if it generally feels a little bit better and helps understand our budget. So the way I wanted to do this was to, in two steps, because in the retirement division, we administer all of our public plans. I think it's important to provide the combined budget because this is sort of the, this is what it takes our team to administer the plans. Only a piece of this is VMERS, but what I thought I'd do is I'd walk through the categories I'm doing in for the combined budget, and then we'll drop it down a level to the VMERS allocation. So bottom line, what this is saying, $9.7 million is what is our total budget for this year. That's up from 8.8 last year. Overall 6% increase. That includes how I'm characterizing it as 4 major buckets. The first one is go to the next slide. The administrative bucket. It's that first little block. And that's really kind of the money it takes for us to administer the plans. It's all staff salary benefits. Kim, did you have a question? No. So salary benefits for staff members, both within the retirement division and within the broader treasurer's office that performs services in support of the retirement systems. It includes our sort of operations like fee for space, our equipment, insurances, supplies, that, stuff you need to run an office. Our comms and mailing, which is, that's basically our member communications, both things that we do to inform members of things that are coming up and just sort of necessary mailings throughout the year. And then education and support. And that's, we're part of a number of national organizations that have membership dues. We do some travel to conferences for education. So that's what that line item is. The next one is agency support. That's really kind of necessary cost because we're a state agency and we receive, technical services from our digital services agency and legal services from our AG's office. And so the state is replete with, we all charge each other pieces. And so this is sort of the necessary piece to function as an agency. One thing I did pull out separately this year is our medical review board. That's our doctors and independent hearing officer who reviews disability retirement applications. They're kind of like a separate agency, and I thought it was helpful to just present them as such in this context and isolate their budget. Third-party services is one that you probably see more than others because we come to you with contract approvals from time to time. And so what I did here was, rather than putting them in different buckets where, maybe a couple were lumped together in technical, I just wanted to peel them out into individual contractors and the services that they provide. So you could see sort of what we're expecting on for these individual services this year. So you may, obviously the actuary, our audits we do census audits for all our employers to make sure that they are reporting correctly to VMERS. Individual towns and schools are on, we usually get them once every 10 years. We just do a sampling, and these are our auditors that go out and do that work. We have a health consultant in the teacher's plan, not relevant here. We have a death match service where we compare all our payees to national, firms that compile deaths so that we can make sure we're not paying folks who have passed away. It happens, unfortunately, but we try and minimize it. And legal, and then the biggest one down at the bottom is VPAS. That's our pension administration system. That'll go up this year because that one, as you know, we went to a hosted solution this year. So you'll see a substantial increase there. And then VPIC just comes right through. It passes, the VPIC approves their own budget and it's allocated to the retirement system. And as a functional matter, that is input into our individual budgets. We don't touch this one because it's something that VPIC has looked at independently. So those are the
we've looked at it independently as VPIC, but it is still overseen by approvals through the governor's office and otherwise. So even as an independent body, there's not independent budgeting authority, just to clarify.
And it's the same thing for us. Honestly, it's a weird construct. I think a more typical construct nationwide is one where the board has oversight over the budget, sole oversight over the budget. Here, at least for the state and the teachers plan, it makes a lot of sense that the state also retains oversight because they pay the ADEC. It's a funny fit for the municipal system, as I'm sure you know, given the fact that municipal employers pay the employer share there. But as I think about it, you know, I guess I choose to welcome the transparency, and I feel like we are all best served with, and I know VPIC's had some particular challenges on staffing and salary, so I am saying this noting that it's not perfect, but I think broadly speaking, our systems are well served if a broad cohort of stakeholders understands our costs and supports them. So I think I always work toward that end. So getting to the specific VMERS, you know, it's in some ways not an overly remarkable story as compared to, you know, when you look at what's changing and what's staying the same. Really, the driver is admin support, and that's our internal costs for administering the plans. It is more costs this year being allocated, or in the upcoming budget year, are being allocated to VMERS. For example, the teacher system is seeing a much lower share of that cost. I think one thing that is true in our systems, and you know, I remember being told this when I first came into the office, is that VMERS kind of is the poster child for the 80-20 rule, like where it might only be 20% of the assets because there's so many employers. And there's a lot of complexity to the system. It can be a substantial part of the work. So as our office was estimating time this year for the upcoming budgeting year, it did allocate a little bit more to the VMERS system, and that's really what's driving that 10.6% increase in the VMERS budget. Sorry. So that's really the major cost driver this year. The other piece is just going back. You know, it may be a large, like our death match service may be a large year-over-year increase, but then you look at it, it's only $2,000. You know, it's a small ball. So that's why we tried to present it in this service. I didn't invent this. I stole it from VPIC. I think they do a good job in presenting the budget. And I think this is a useful way to do it. So this is the budget that we are moving forward with in the legislature this year. Happy to pause at this point with any questions.
So Tim, when you're trying to allocate the budget across the three systems, I think you were kind of touching on this just now. You're not doing that on a percentage basis. You're actually kind of trying to get a handle on how much effort your staff is putting into each system and allocate it that way.
Yeah, it depends. For when you're looking at some third-party services, that might be on a percent basis. Like we have typical three-way splits that are based on you know, assets, lives, those kind of metrics. When it is the admin services, which is our staff time and budget, yeah, we're looking at you know, I have one person who is pretty much dedicated full-time to VMERS because she's the one that liaises with all of the employers and makes sure to collect the bills and keep all the money straight. So, she'll be very highly allocated to VMERS, whereas other people, we talk to managers and we try and do we try and get a good sense of, okay, how are you spending your time? Some of them aren't going to be as discreet as that person I told you about who is directly focused on VMERS. Our folks in our front office, what we call our front office in the retirement division, who are taking the calls. They're taking whatever calls they are, and we try and estimate how much you're getting from the different systems, how much work are you spending on the different systems. So we have different ways. So it's kind of effort based on the admin services piece, whereas for others it might be sort of member or asset based.
Sure. And how about for the VPIC pass-through?
VPIC pass-through, I think VPIC does it on AUM.
Okay, so they're actually doing the allocation for each. Okay.
Yeah, we do the allocation for each.
I mean, again, as you said, this is kind of small ball compared to the overall budget. The agency support that comes from other parts of the state, how does the AG's office decide that they need $26,000 from retirement? Like, is that percentage? Is that?
Yeah, they have, I don't know the exact methodology. We have a lot of internal service transfers. So I can't speak exactly to how that is determined. I think the auditor determines it based on dollars, because they're auditing. How the AGs and ADS does it exactly, I'm not sure, but just to sort of point why it's important, this year we do have an active lawsuit right now, and we have an AAG who's defending us. So we also utilize them for contract reviews. They're a necessary step whenever we're doing a contract, so they can review our contracts as to form. Fortunately for them, Justin makes it easy for them, but they're there in an important step nonetheless. So, so all these entities, DHR, they make sure we're all getting paid and have our benefits in order. So it's all, I think, we're getting valuable services from all those, but I would be lying if I think anybody would be lying other than a couple people in the state if they could tell you the exact formula, how they determine.
Sure. Okay. Any other board members have questions on the budget?
Hey, John.
Yeah, I do. Yeah, I think it's always good to ask about that cost allocation, Tim, and to try to understand the formulas if they're willing to make them available, at least in my past experience. But my question was about the 223,000 increase in admin support. I don't need a full blow breakdown of that, but what are the big categories in that 200,000?
I think let me just start, if I can build it from the baseline. 9% that you're going to see there is going to be generally across the board, right? Like, that's the average, and that's going to generally be what is salaries are going up, steps, benefit costs are going up. So a good portion of that is not allocation as much as it's inflationary pressure on admin support. The balance of it, I think we're looking for there's both allocations within the retirement division and from services that are being provided by some of our colleagues in other parts of the office. And I think it's split roughly. I think within the retirement division, we're putting a little bit more of our benefits folks, counselors, into VMERS, because they're spending a little bit more time basically counseling VMERS members and going out and doing work to educate members on their benefits. That's been a push that we've been doing to get out. And frankly, it's easier to do for the state because there's a single employer. And for VMERS, we just have so many employers that it takes a lot of time. Okay. So that's a piece. And as I understand it, I think there's some more of our the financial and IT teams that are kind of coming into that space as well, based on their own determination that as they allocate their workflow, particularly on the IT side, where there's more interface with a number of employers, and in the upcoming year, we're going to hopefully be moving an employer direct model. We're hoping we can get that forward, but that there will be some additional work there. So I think that's what's driving those pieces at the broad level.
Okay, thank you.
So not seeing any other questions. If I
I'm
can,
sorry, I'm just
go ahead.
noting, I'm sorry, the footnote with does not include new requested position, salary and benefits estimated. Is that something that is anticipated to get approval? And do we know how that would be allocated? Would it be all specific to VMERS?
If that would match Bill's allocation, I think roughly, and it would be probably, as I'm thinking about it, a little underweight to VMERS, all things being equal, because a lot of the work would focus on health insurance, which obviously isn't a thing for VMERS. So I don't have that exact breakout, but it would be, I would suspect, if I'm guessing right now, in the 20% range. Don't hold me to that. So it'd be a small amount. With respect to your question on Insight, I should mention VPIC is also asking for a position that's also not included in here. And do I have Insight? We are making a strong push. We're very fortunate to have the support of David and Mike, who are advocating for both positions when we get a chance. To date, our position is in our omnibus bill that was unanimously passed through House Gov Ops and is up today in Ways and Means. I think it's up in Ways and Means for a non-retirement issue. I would expect that as we get to House Appropriations, that's where they will look more carefully at the position, and they may pull it from our omnibus bill and put it in the budget. There may be sometimes they do that kind of. We like to keep all appropriation items in the big bill where they can, so that may happen, but it's in now. And I think folks understand the need, and we've been, I think, very clear in expressing it. Can't tell you anything beyond that. David, any other magic insight that you might have into the?
No other magic insight so far. We've had approvals from the committee, the key committee so far that's reviewed it. House Gov Ops did vote it out favorably with that. But yes, there are some key stops along the road, most particularly the Appropriations Committees both, but the next one will be House Appropriations, and it's hard to know for sure what will happen there. We're certainly hopeful that we'll keep this going.
Thank you.
And just a couple other things that I find interesting. So I wanted to, these aren't strictly within our budget, but I think they're important for us to keep an eye on at the board level. In the past, we used to have a separate budget item in the big bill for administrative cost, and we started to roll that into the ADEC. So when we're saying how much we have to fund, that is a gain loss item, just like mortality, investment return, deaths and mortality, the same thing, retirements. So what this looks at is what our assumed cost would be. It's 0.45% based on projected payroll. And then we look at our actual cost, and actual is not going to match up here with what's on the budget sheet before, because I think we use different forms of accounting, cash versus accrual methods to replicate these two. So recognizing that it's not in the same exact format. The reason I think this is interesting is that we have had some, generally we've seen gains in our admin costs, which I'm glad to see. You don't want to see costs that are going up so much that you're taking a loss. And as we go into the next experience study this coming year, I think that we'll look at the assumption, and we'll keep an eye on it as we go forward. So just another metric to evaluate our admin costs by. And then here, as we were putting this budget together, one thing that we realized is there's a lot of work we do with stakeholders and vendors that's not in the budget. For example, all the work we do with RBK, with Empower, we pay fees, but those fees are paid not from our general budget, but from plan participants. So what we tried to do, and this is very rough, and this is the first time we've done this, so hopefully, it presents a useful look or guide. I just wanted to have generally, what we're paying in what we paid in 25, and then using like basic, past performance in increases in assets or participants. We just rolled that forward to give an estimate about what we're looking to pay in 26 and 27 for our Empower plans. For RBK, that's a flat fee that is going to go up by a certain percentage in the contract. For Optum, that's another asset and per head fee. Delta Dental, we have a stated rate increase that we know our members are going to be paying. So all these things, we just kind of wanted to provide a rough estimate about what these cost levels are, even though they're not in what's historically been presented to boards as our budget. Things I think you should have a general understanding of. And I just put all the different systems together in here because some of them are cross-cutting, others are, wouldn't apply to one system or the other. So I'm going to stop sharing now. That's generally the budget presentation. As I said, I'd like to come back later in this session with this for a vote of approval on the budget, but I wanted you to have a first look and not just kind of hit you at the 11th hour cold. Here's the budget, please approve. At least you can see what's coming and ask any questions.
Okay, thanks. And that brings us to your legislative update.
And that's just going to be very brief. I think we almost just did it really with our omnibus bill. We have that is moving well. David will be testifying today at 3:15 in Ways and Means. We hope that's a brief stop and not retirement related en route to House appropriations within the next week or so. But at present, I do anticipate that omnibus bill, which has our our funding task force, our OPEB authority transfer, a couple other little pieces. We hope that's going to make crossover and move smoothly this year.
Sounds good. And so any other business to come before the board? Anything from you, Tim and team?
Yeah, the only thing I just wanted to reference, I mentioned it last time that the state board was looking at our 457 plan, the fees that are being charged for that plan. We've been, because we had a long-standing plan expense account that we were trying to work down, we have been subsidizing it. So that plan will see a fee increase effective July 1. The state board just voted on it this month, going up from 3.5 basis points to 5.5 basis points, but also adding a $24 per participant annual fee. So that plan will now be self-sufficient and no longer relying on that historical balance that we've been using to subsidize that fee amount. There'll also be a $5,000 fee waiver on low balances. So if you have anything below $5,000, no fees. Idea being incentivizes people to get into the program and start saving. So I think they went through a really good process, but I know a lot of your members are in the 457 plan. So just wanted to provide that as a FYI. If you have any questions on it, you could shoot them my way and I'm happy to talk more about it.
Sounds good. Any other business from any of the board members?
Nope.
Okay. Well, next meeting is on the books for March 17th. Look forward to actually being able to see people on that one. And with that, unless there's anything else, I will entertain a motion to adjourn.
So moved, sorry.
Second.
All those in favor of adjourning, please say aye.
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 Thanks all. See you.
Thanks, everyone.
See you in March.
Thanks, folks.
Bye.
Bye-bye, thanks.